This is Don Kaufman. March 17th, 2023. Happy St. Patrick's Day. Just about 1 minute to go to the cash close here on this Friday afternoon. You got yourself a banking crisis, you got yourself inflation, you got rate hikes, and you've actually had a rally this week. Yeah, more of a question there than a statement, but a rally in the face of all the adversity inside of the marketplace. Let's actually start off by kind of breaking down a little bit of the trade activity this week. But what I really want to do on this weekend's update, very much forward looking, because once again, what are we going to be dealing with next week? Enter the Fed. Oh, that's right, everybody. If you were sick of hearing about the Fed this past week, you're really going to get to hear about them the coming week as they deal with, of course, rate hikes. We'll discuss that and much more here, of course, on the TheoTrade weekend update, right down to it. One of the first things I want to cover here is a little bit about some of the trade activity. And again, we are coming right into the cash close here. Bells are going off everywhere. It is over. Closing the week out here right at about this 39.49, just a hair north of the oh so important 39.31, which I'm going to discuss here momentarily. One of the first charts I really want to look at is not so much the S&Ps on a 1 minute. I want to actually look at the S&Ps on a 30-day 1 hour. And the first thing I want to emphasize is in terms of trade, right? If you look back, okay, at approximately the last, let's call it 8 to 9 trading sessions, right? So really it breaks down to, again, just about a week of trade here. Effectively, what you're seeing kind of kicking off again, like last Wednesday, there's almost no risk, nothing. You heard not even a hint of a banking crisis. Oh, then we actually hear the term banking crisis Thursday, sell side activity. Again, it's just over a week ago. What are we at from that point forward? Absolutely nothing. I mean, if you had known even 2 weeks ago, and somebody would have said, regional banks, they're going to be in a little bit of a crisis and, the Fed's actually going to have to step in and all the other banks are going to have to step in, would you believe that the S&Ps, for the most part, have been massively unchanged in that particular time frame? There's no chance. Like order flow has actually played out rather well inside of the S&Ps. And it's one of the things that I want to stress. One of the other things I want to stress when I talk about, the markets like banking crisis, inflation, and rate hikes. And at the same time, we are in fact ending this week. I know we were in oversold conditions last week, but we're ending this week higher. There has been a rally. Is it a substantial rally? No. I mean, we started the week right around this like 38.60. We're going to end the week here in the SPX right around 39.16. So, just over a 50 handle rally inside of the S&Ps. And by the way, 50 points inside of the S&Ps is pretty nominal. It's about but it is. It's good for about a 1% move to the upside inside of the S&Ps. And again, in the face of adversity, you couldn't have convinced anybody that was actually going to be the case. Nevertheless, one of the most important things about trade right here, which you're going to hear me mention a lot, is I believe we're at a very, very critical kind of inflection point. And that inflection point really is, and again, I'm going to label it on your screen, and because we're going to talk about it extensively here in a minute, it is the 39.31, that is the last gasp, the last hope for the S&Ps. One of the things that we're going to talk about that's really at issue here is there's a lot of indicators. Like if you have ever heard the terms like risk on, risk off, but in terms of indicators that display risk, for example, like VIX, your volatility, it's through the roof. Your volatility futures, they're in backwardation. We're going to look at all of this. The bonds, it's like they're ready for Armageddon. Get under your desk, start rocking back and forth. Like every major risk indicator that you're looking at is screaming, out to us. And at the same time, look, the S&Ps just keep staring at it and laughing and keep moving forward, and we're not tanking. And it's a very critical point to be had. And it's probably the biggest takeaway is that trade, even though it's slightly higher, it's downright sketchy out there. Now, what we're going to look at here to begin with is, well, some of the banks, because that has been an area that's gotten decimated throughout the course of the week. And I do want to bring up the XLF first, XLF first. And the reason I want to bring up the XLF happens to be the big boys of banking. So the big boys of banking have aligned right now, okay, after tanking from roughly 36, okay, they're all the way down to 31. Now, the point that I was trying to make a moment ago is through all the, the difficult, I guess, headlines that we've had, and CPI came out earlier this week, and it just went on, and bailouts. But through all the difficulty we've had, yeah, the S&Ps are largely unchanged, but I cannot say the same about financials. Financials, you have to come up with a new term for oversold conditions. We've literally just moved from 36 to 31 inside of the XLF. Nevertheless, I want to make this very, very clear, okay? I do not believe that sell-side activity would be done until we got all the way down. And again, let's label it on here. I was talking about it on a Wednesday night video, okay? Roughly the 2650 level inside of the XLF. Now I'm bringing up the XLF to kind of kick this off because there's the feeling, if you will, that whatever's going on is just limited, okay, and confined at this point to regional banks. But the XLF chart shows anything but that, right? Let's look down at some of the financials themselves. Speaking of the XLF, let's bring it up on a year-to-date basis. The financials are now down about 10% year-to-date basis. What does Goldman look like? It's down about 12%. JP Morgan, it's down about 6-7%. Bank of America getting absolutely annihilated. It's actually down almost 17% year-to-date basis. Okay, Citi, okay, almost unscathed in this. All right, Morgan Stanley, almost unscathed. Wells Fargo, down about 10% in line with the rest of the marketplace. Also worth noting, Charles Schwab, which is very fond of money markets, down almost 30%. Okay, no cause for concern just yet. But the reason that I'm bringing this up is not necessarily to cause panic. It's to show you that whatever's going on right now inside of the banks is not regional banks. It's clearly, okay, much more significant than that. And we're showing, an underlying like Charles Schwab that is clearly labeled too big to fail. And when we talk about too big to fail, like a lot of people are not aware, Charles Schwab has a market cap equivalency to and larger in most cases than Goldman Sachs. And very few people are aware that, how did Charles Schwab all of a sudden become a $100 billion company? Let me tell you something, they were worth a lot more than that, a little over a week ago. So whatever risk that you think, look, okay, banks stepped up. And when I say banks, I'm talking to Bank of America, okay, Citi, JP Morgan, Wells Fargo. Ironically, Wells Fargo just went out and actually borrowed $9.5 billion. I say borrowed. They raised more money, okay? They went out and actually raised about $9.5 billion, turned around and gave $5 billion of it and deposited it with FRC, okay? Now, we'll talk about that here in a moment. So $30 billion, all right, was handed to a bank that was in trouble. The bank, as I said, okay, FRC, First Republic of San Francisco. The only issue is that if you look today, this particular bank is right at lows. It's actually facing the 20 level. The absolute lowest saw the other day was 1753. There was even times today where this stock was effectively halted because of volatility. The reason I'm bringing this to your attention, I want you to see that they're actually coming in and lending to the bank, but its survival, okay, is far from certain. And it's one of the key points to be made in this particular marketplace right now, is that if you look at the regional banks, they also took very significant hits again today, down some 6%, and they are very close to actually breaching some of the lows. So before we actually, start high-fiving one another and start talking about how the marketplace actually rallied this week, you better realize the banks, okay, this is not the time to go bottom fishing. If you actually look at KRE, which again is the ETF for the regional banks, KRE, its volatility tells an incredible story in here, specifically with volatility as far out as 30 days, in excess of about 80%. Okay, now if you're curious about volatility in FRC, when I say it portrays a very different story, okay, this is now an underlying that is clearly fighting for its life. So I wanted to show you the ETF volatility, upwards of 80%. And then I want you to look specifically at FRC, which has volatility 35 days out of 433%, effectively pricing in their demise, if you will. It doesn't mean they have to go out of business, okay, but I'll tell you right now, $30 billion fixed absolutely nothing at this point. There is also considerable, okay, and wild amounts, okay, capital being taken by every major institution out there. Okay, they're approaching the Fed discount window with just, okay, furious debts that they're actually taking right now for overnight lending. So the banks, okay, in total, bridge loans, $140 billion this week, $140 billion thus far this week, okay? Again, in total, the lending programs have increased the Fed's balance sheet by over $300 billion this week. So with that, we are now effectively on Fed watch. The Fed's coming out next week. What's the Fed going to say? My take is the Fed's actually going to raise by 25 basis points. One of the things that you have to understand, coming into next week, it's going to create a tremendous amount of volatility because it's not about what the Fed is going to say. It's about the Q&A for the Fed when they start attacking them about the banks, the regional banks. They're going to start attacking about quantitative tightening. Quantitative tightening, by the way, looks a lot like quantitative easing when you have a $300 billion that you've extended the banks inside of last week. Think about that for a second. Not enough people are talking about the fact that we are no longer apparently in quantitative tightening. We might be easing, which could actually cause more inflation. So it's a party, people. Join in. The Fed is just caught, okay, between a banking rock and an inflation hard place. There's no easy way out of this. Like, all right, now, the next thing I wanted to get to, so all I'm doing is presenting, yeah, you got the Fed coming, but the most important thing about this marketplace right now, it's not even where the S&P is closed, okay? It's not even where they're going. What I don't like in here, okay, is volatility. So if the marketplace is kind of sounding the all clear, because we rallied, right? I know that the S&Ps are closing lower today, but overall, the marketplace was up on the week. Volatility, though, very close to the highs of the week. Okay, now that's easy to say, like, oh, look at the VIX. Like, let's dig a little bit deeper and go to the volatility futures. And the volatility futures, we've actually been flirting with contango and backwardation throughout the course of the week. We have closed today in, okay, an effective backwardation. Now, when I talk about backwardation, I'm talking about, okay, April volatility, okay, versus, for instance, May volatility. And the April volatility closed, okay, at roughly 26 on the button. The May volatility closing roughly at what? Okay, 25.82. So we're in a version of backwardation, which basically says that in the next 33 days, the risk is actually greater than it is out in May. So it's basically like you're on fire and they're going to try to put you out between now and, like, you know, the May expiration, but the risk is actually greater right now than it is out in May, which is just wild to think about. Now, the reason that I'm bringing this to your attention is if you looked at the S&P futures, and just do me the favor here, okay? The last few days in the S&P futures, okay, there has been a rally. I can see the trend. I'm drawing it on your screen, okay? I can see the trend. It is to the upside, but it's mild, right? I see the upside trend inside of the S&Ps. Or better yet, you can come over to the spiders. The spiders illuminate this maybe a little bit better because they don't have all the overnight trade, but there's an upward bias to the spiders, okay, throughout this week of trade, no question about it. But at the exact same time, then, why is volatility butting up against its recent highs? Why are the volatility futures projecting more risk? Okay, if I look down at what's called VVIX, the volatility index, why is that basically at its closing highs right now? Because we're sounding the all clear? Far from it. Far from it. We're promoting that there's going to be considerable risk from this point forward. In addition, so volatility is just screaming risk in the markets. And in addition, let's look at bonds. Let's look at Bitcoin, right? Take a look at the bond market. Bond market effectively having closing highs. This is duck and cover. When I call it duck and cover, I'm not trying to scare you. I'm telling you, okay, you don't throw billions of dollars of, you know, capital into bonds, right, at prices like this unless you've got a fear trade going on. Okay, that's the only, you know, summation that you can have out of this. You look at the notes. Notes are closing at highs, taking interest rates effectively lower. Also pricing in a very deep and cutting recession. So bonds, okay, are flying in here. Then with everything that we've been through inside of crypto, look at Bitcoin, okay, exploding to the upside. Meanwhile, all right, and I'm not even going to go that deep into Bitcoin, but, you know, you realize what FTX has done in, you know, damaging just the entire, you know, genre. They damaged the entire genre. One firm, which is FTX, you know, damages everything in an asset class of crypto. It doesn't seem to matter. They're buying it anyway right now. And it's one of the points to be made, because is the dollar coming down dramatically? Well, not really. But I'll tell you what, okay? Did you look at gold today? Gold should scare the pants off of you at this point. So what do we have? We have volatility promoting pretty high risk. We have bonds absolutely unequivocally confirming really high risk. You've got crypto, which no one has wanted to touch, not even with anybody else's money, showing really high risk. Gold is actually flying up. And yeah, the dollar's come off, but the dollar has not come off nearly as much as gold has just flown to the upside. Tell me, okay, are we through the worst of it yet? Because nothing I'm looking at on the screen is promoting that. Then I want to cruise over to the energy sector, because the financials were not the only sector that tanked. The energy sector got absolutely decimated. Look at energy sector in terms of auto expected moves. The energy sector got crushed the week before, got annihilated this week. 2 deviations, okay, 2 standard deviations, okay, out of the expected move. So this is, in my opinion, why is energy and oil tanking? All right, and I'm actually asking you, the only actual reason I can come up with, they're pricing in a deep and cutting recession. Once again, I go back to the S&Ps. The S&Ps just don't seem to follow suit. They're not promoting the exact same thing. Now, meanwhile, okay, there is a massive divergence going on in the marketplace. The divergence is between Nasdaq. Okay, check this out, because I saved the best for last. When I'm talking about a rally up here, you're like, yeah, the market finished a little bit higher. Really? Take a look at the QQQ. The Nasdaq, it doesn't just explode to the upside. It's a 2 standard deviation move. Okay, it's again double the expected move, and it's just a massive rally inside of the Nasdaq. It's almost like the Nasdaq and growth stocks, they're immune to everything else that's going on. Meanwhile, I point to the VIX, the bonds, everything. Okay, everywhere you look on the screen, again, oil. I think oil prices in a deep and cutting recession, but right now it doesn't matter. Okay, we're seeing this critical divergence. Speaking of a divergence, I think it's also worth noting, of course, that the Russell, the IWM, has been really annihilated. This year was up, I believe, 13% at one point, even more than that. It was up almost 15%. Is now actually down. Okay. 1.25% on the year. So this divergence, and the reason I wanted to bring this divergence to you, if you're kind of curious about what's the next major move in the markets, okay? To me, the next major move in the markets, we already know, all right, that there's just a critical amount of risk inside of, well, the financials. The financials, they had their rip your face off rally on Thursday, and they got clocked again on Friday. Obviously, the XLF down by 3.2%. The key, of course, though, okay, this next week of trade, you can look at the advanced decline line, and I want you to look at stocks next week like Microsoft. I want you to look at stocks like NVIDIA, okay? If you want to know what carried the NASDAQ this week, you need only look at about Microsoft and NVIDIA. Sure, you could throw a little Google in there, which had a big rally here, but Microsoft, blistering move to the upside. Okay, I'm going to talk about that trade in a moment. The reason I'm going to talk about that trade is this one right here, Microsoft is critical. The slightest move to the downside would be an indication that the divergence is actually coming to an end. And if you want to see the next major move in the S&Ps, okay, you're going to see ultimately the market start to converge upon itself, and that is much higher degrees of correlation. Instead of 18 stocks trading to the upside, okay, you're going to see, for instance, like 100 stocks on one side of the trade, or 100 stocks on the downside of trade. But I believe that this next week, with Fed coming out, the divergence between Nasdaq financials and energy is going to come to a screaming halt. Okay, look for full-blown correlation in here. Okay, on days, especially if we're going to go down, okay, look for days where they start selling stocks like Microsoft, that there is no hope, that there's nowhere to run to, nowhere to hide. And that's one of the critical aspects for trade right now. The divergence is what is saving this marketplace. The divergence, okay, and again, a rotation into technology, which is wild in my opinion, but in wonderful shorting opportunity, any way, shape, or form. Okay, even if the market starts to rally back up, they've already bought Microsoft. So I took a nice short position in here, which is exactly what I'm going to talk about next. It's called Get Your Trade On, this week's profits and losses. First thing up, Catapult. So Catapult is a strategy to where I go out and I'll sell, okay, S&P options and futures. Okay, not to get into details, but I'll sell S&P options and futures. And I go out and I finance a variety of different trades with that. One of the trades that I financed was in an underlying that called Caterpillar. And the Caterpillar trade, I exited a $10 wide spread for $7. And then I exited, of course, a $10 wide spread for $5. So my average out price is $6. Okay, and you're like, whatever. So it's $1,200 that I basically collected back on that one. What did I pay for the trade? Nothing. It's $1,200 basically in my pocket. This was one of the first, it was actually one of the first Catapult trades that I did, and it's a winner, 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 chicken dinner, right there inside of Caterpillar. So I had a Caterpillar Catapult and out for a $6 gain. It's our first wildly successful trade, okay, in this month. So this month, that's the first wildly successful Catapult we've had. Now, in addition to it, that particular Catapult is working extremely well. What else do we have working? VIX. Our VIX trade is actually in the money. The trade is up pretty phenomenally. Again, we've paid nothing for the trade. One of the other trades that's actually paying off very, very nicely. Okay, I'm actually gonna have to switch accounts over here. I have, okay, Catapults. Pull this up right here. Starbucks, okay? Inside of my Starbucks trade, I have a 3-lot, just 3 contracts. And you think 3 contracts, but it's $10 wide spread. This trade can be worth as much as $3,000. Again, what do we pay for it? Nothing. So we paid nothing for the trade. It could be worth as much as $3,000. It is now effectively in the money. Starbucks moving the right direction. One of the other big ones that I have on is a 4-lot of a $10 wide spread inside of IWM. To put spread in IWM, it's already up 120%. Thing still has 63 days left to expiration. So we are kind of firing on all cylinders when it comes to Catapult. And again, this was a slow start to the month. Here we are all the way, March 17th. I'm pulling off like the first really profitable Catapult. But right now we have a multitude of different trades. They're on the dance floor for big returns. Starbucks, IWM in the money, VIX in the money. It is rare to see this many trades. You have to understand with Catapult, you only really need a handful. Like if one of the trades comes in like an IWM, it's $4,000 of P&L. I didn't pay anything for it. All right, what else do I have on? In my option premium selling, I actually covered a short call, the 45.50 call inside of the S&P options and futures. Okay, and I have just put on a Microsoft in-out spread. For those of you that don't know what that means, I got a little bearish. I bared up just a bit inside of Microsoft. This is a trade that's actually going to exist for the next 30, 35 days. You can see we put this one on. It's the 280, 275 put spread inside of Microsoft. All right, I'm teed up very, very nicely though for next week. So I've got a couple of Catapults that are in the money. I've sold a bunch of premium, okay, covered some premium, and got the Microsoft spread on. Nevertheless, what are we actually going to be looking at next week? Okay, a whole lot of chaos playing out. So if we actually took a look at the SPX expected move, all right, what is our expected move? Well, in the previous week of trade, all right, we effectively had plus or minus $115 of expected move. Did we hit it? No, but we missed it, okay, by a margin of less than 20 S&P points. So we actually came up just shy of the upper edge of the expected move, contracted back. Again, the S&Ps this week, I mean, all we really did, it's a pretty meager trade. We exploded higher yesterday, pulled back today. Okay, dogs and cats living together. As I said, the S&Ps were a little bit of a disappointment in terms of overall, movement. They moved. Okay, but we ended up actually tracking right back to that same area, and we're still talking in the S&Ps about 39, 31. Meanwhile, what is the SPX projecting for next week? You're going to love this, because if you think that you just went through kind of a rough week and you're like, woo, we got through that one. Yeah, well, next week, over $120 expected move. Put on your big boy pants, because we're going in. But the way I live for this crap, the bigger the expected move on the week, okay, the better. Okay, I love it. So you're thinking to yourself, holy crap, how could this be? Because again, it was only 9 days ago. You never even heard of a banking crisis. Never even heard of a banking crisis. We get thrown into, pretty much hell in a handbasket here in the near term. The markets start breaking down, then we start channeling back and forth. But this week we had a big CPI report that was, a total dud. Meanwhile, next week you got Fed. You got Fed, but it's more or less, I'm telling you, the market sees something. Volatility wouldn't be where it is, okay? The expected move for the week wouldn't be $120. You have to get ready for an ample size move next week. $120 expected move is very unusual. And not because it's a $120 move. It's unusual because we didn't even move the $115 we were supposed to this week. You would think that volatility would contract. And people, that is exactly my point. When the market is screaming that next week is going to have heavier volatility than the week that we just passed through, if I were you, I would pay very, very careful attention because we've just seen, again, the banking crisis, inflation is out of control. We're talking about rate hikes, and we saw a rally. Meanwhile, volatility picking up, bonds rocking to the upside. They're even buying Bitcoin and gold, okay? Chaos is abound. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.